You know, with all the pandemic and all of the stuff we're dealing with, one would have thought that it would have wreaked havoc on the yachting business. At least that's what we thought a year ago, February. Look at it now. That's all I can say. I know that chartering is record-breaking right now. Despite all the obstacles that are being set before it, it's record-breaking. The charter brokers are going crazy out there trying to find boats for charters right now. So I committed a MC faux pas, and that is I didn't. Melissa, you still here? Just walked out. Okay. Well, when she comes back in, everybody can stand and give her a big applause. No, Melissa is. Failed to mention, although it said it on the graphic, Director of Maritime Communications for Isotropic Networks. But she's also a colleague of mine on the board of directors of the International Superyacht Society, a co-backstage director of the ISS Gala, and also on the boards of ISS and of the United States Superyacht Association. So we're glad to have her here. This is being recorded, I mentioned earlier, don't worry about that, but you need to be taking good notes. Being an ex-school teacher, you never know, we may put a pop quiz on you at some point in time. You're not allowed to leave unless you get a 70 passing grade or whatever, but just take good notes. I'll tell you why at the end. So our next speaker is Edward Bragg of Wells Fargo, and Ed leads DF's Marine OEM team in the USA. There's some acronyms for you. And is general manager of DF's joint venture, Brunswick Acceptance Corporation. Ed joined Wells Fargo in March of 16 as part of Wells Fargo's acquisition of GE Capital. Prior to this, Ed spent 29 years with GE Capital and its predecessor companies. He's focused on the recreational marine sector, and he fits in very well with us here. And may I introduce to you to give us an economic forecast, Edward Bragg of Wells Fargo.
Thanks, Bob. Thanks, Paul. Thanks for having us today. Special thanks to Chuck Cashman for the invitation. So you just had a little introduction on who I am, but a little bit about our company, what we do. We are the inventory financiers to the world, really, for recreational marine products. But that's not all we do. We also do RVs, we do motorsports, we do outboard power product stuff, we do white goods, we do technology stuff. And we do that, we finance inventory in inventory-intensive industries, anything that has a supply chain that looks like it goes from manufacturer to dealer to end user. And we've been doing this for over 60 years. Wells Fargo bought our company in 2016 from GE Capital. I represent the boat industry for Wells Fargo, and I've been doing that for about 35 years. We've got a team of roughly 100 people dedicated to the marine industry up in Chicago, Illinois. So the context of the presentation here today is I'm going to go through a few slides here. If some of them might be eye charts through the size of the screens, so I'll do my best to talk through them, but Emma Ross has my presentation, and anybody who'd like a copy of it, you could contact her, and she has my approval to send it to anybody who asks from this meeting. But what I'm going to go over today is I'll have a few pages on Wells Fargo's recent economic insights that are kind of relevant to our industry. They put out a lot of pieces, so I filtered through just a few slides. There's much more than that. If you have a special interest in any area, you can reach out to me, and I can find something from them. And then we're going to go over some of our own marine data market insights. Now, we finance new inventory primarily, so new builds for boat manufacturers that go to a dealer that end up getting sold at retail. We do about 110 to 120,000 new boats a year, roughly half the market. So the data that you're going to see from our business is a fairly statistically significant sample. And you'll probably find more similarities than differences with the new boat side of things and how that's going, as opposed to the specific realm that you're operating in, whether it's pre-owned or charter. So the data that I'm going to show today is specific to the United States as well, but it also includes, boats being imported from Europe, in the yacht space, as well as our domestic manufacturers here. And lastly, I don't know if you have an attorney who's going to be talking about this later, but there is this ugly thing going up north of the border called a luxury tax in Canada. I'm going to talk briefly about that, what's going on with that, and how that is trying to be fought. And then we'll end up with a little Q&A. So at that point, we are really, truly in the best of times. Bob kind of mentioned it, who'd have thunk it? The government mandates a lockdown in a deep and short recession. Normally, we're on the losing side of that trade as an industry, but we got a boating bonanza going on in all facets. New boats, pre-owned, charter book. Also, the boat clubs are having record sales. But it's not without its problems, because we've got supply chain things that's wreaking havoc on inventory that it's going to take a while for us to work through. So I'm going to go to my first slide here, Wells Fargo's economic update. So I will just talk on the right side of this page here and talk a little bit about GDP forecast for 2021 right now. Wells Fargo's forecast I have here says a 7% GDP growth rate for 2021. So anybody who keeps up on economic things will realize we've been kind of in a 2 to 3% growth rate for quite a bit of time. And now we're staring at 7%. Just last week, they upgraded it to 7.3%. And they upgraded it for a few reasons, but the long story short is that's going to be the strongest growth rate since 1951 for this industry, for this country. And it's really going to be about the fact that we've got consumer spending is just on fire. And it's been on fire for any type of goods, which includes boats. It's about to transition and is transitioning, and you heard this with the travel segment just before, to services, which is really 2 times the size of consumer goods purchases. And so a lot of the things that have been locked down, like travel, hotel, restaurants, bars, cars, sporting events, concerts, all those things are starting to open up. And it's going to be an earthquake of spending that's going to be coming on, because there's been $1.8 trillion worth of excess savings piled up by consumers that's getting ready to be deployed as people have some urgency and appetite for getting somewhat back to normal. Going into 2022, that's going to carry over to 5.6% there. They upgraded it to 5.8% last week. So again, a super strong GDP forecast. I will note that Wells Fargo is on the higher end of the consensus forecast for this, but the combination of this opening up of the economy, the services spending that's just going to explode, and the tremendous amount of cash that's sitting out there in the marketplace is going to drive this. One other thing to note on here relevant to our industry is rates. Rates are going to be anchored low by the Fed through the end of 2022. The Fed is more concerned about jobs than the inflation pickup at this point. The inflation pickup is actually more real than they're saying. But right now their focus is on jobs for the foreseeable future, and we're probably going to have close to a 0 interest rate policy by the Fed, through the end of 2022. So a couple charts here. I talked about consumer spending, and it's broken into 2 buckets, goods and services. And on the left side of this chart is a chart that shows durable goods spending. A boat is a durable good. It's a big ticket item. And what the blue line shows you is what would normally happen in a recession on the economic impact of durable goods. Normally, when we have a recession, people stop buying boats, and then over time they start buying them again. And through the business cycle, that starts to grow. But what we saw in the orange line is we got 5 years of growth in durable goods spending in 12 months. And it wasn't just boats, it was RVs, it was cars, it was every big ticket item people went out and bought. And the 2 categories that led this spending were autos and recreational vehicles and goods, of which boats is part of. It was about a 30% growth for that category. When you look on the right side of the page, the services side, which I mentioned before, is 2 times the size of the goods spending. You can see the economic impact of the shutdown on the economy. And services is really broken up into 2 things. There's things called staples, which is like healthcare, insurance, finance, housing, and utilities. That's stuff you have to keep paying for. It really doesn't go away. But the discretionary and the other services spending, which is about 40% of this number, really took a hit because it was really all the fun stuff that you couldn't do anymore and spend. You couldn't go to bars and restaurants, you couldn't go to concerts, you couldn't travel, and that took a giant hit on the right side of this page. And so what happens when you have a giant hit and then you change policy and you open back up, there's pent-up demand that's going to happen, and there's a lot of cash on the sidelines, so it's going to snap back quite a bit. And what we're going to see is about 4 to 5 years worth of growth in services spending contained in the next 9 months, and that's what's driving this giant GDP forecast that Wells Fargo has for 2021. Now, looking at the left side of this chart, these are all the personal consumption expenditures by type. The orange line at the top, that's us. That's durable goods. That's boats that are in there. And in 12 months, we got a big uptick. But interesting to note that the forecast, that dotted line for 2021 and 2022 doesn't collapse. One would think, and our dealers fear, that with the reopening of the economy, some of the interest and attention by these new boaters that are coming in is going to be diverted. But there's so much cash that they can spend, the $700 billion of services spending growth and still have lots of money left over because they've banked $1.8 trillion worth of money. So goods spending or spending on boats does not have to collapse. In fact, there's still runway in the business cycle from what we've gained so far to what we usually gain in a traditional business cycle. But where this chart differs is the line on the bottom, which is services spending, which took the biggest hit because the economy was shut down and you couldn't do things. And today it's still 5% below pre-pandemic levels. And that's expected to drive the economy for the next 2 years. But on the right side of this chart is the problem spot for all of us, and that's inventories. And it's not just boat inventories, it's really inventories of every type. We have right now in our history the leanest inventory to sales ratio that we've ever had since it began being measured. So their inventory depletion is not just a boat thing, it's in every inventory intensive market. And the supply chains are entirely disrupted. It's a global supply chain thing. It's not just a local thing. But in the products that we finance, I mentioned the various types, RVs, boats, motorsports products. Every industry is affected. It appears like the boat industry is a little more affected than the other ones. It's a much more complex manufacturing type compared to an RV, which is more of an assembly, or an ATV. So it's just taking a lot more labor hours to do it. It's a lot more inefficient to do it. The supply chain is more gummed up than ever. And so we're feeling it a little heavier than usual. But as I mentioned, when the services spending gets turned on, the fear of our dealer council was that I'm gonna lose momentum at retail. But just in the first quarter, consumers banked $1 trillion worth of excess savings. They already had a high savings rate going into this pandemic, and now they banked another $1 trillion. So if they spend $700, they still got $300 left over on top of the $1.8 they've already amassed. And so there's just so much money out there that it's going to find a home for it, and hopefully they'll find a home for a boat, and hopefully we'll be able to produce a boat for them to have it. Now this is moving into some of the Wells Fargo data. So this is our inventory book of new boats. We finance boats from 13 feet to 85 feet. The vast majority are in the middle of that. And what this is doing is showing you the weekly floor plan payoffs, which is really a proxy for retail sales. So dealer buys a boat, dealer sells a boat, dealer pays off his floor plan when he sells it. And what this is measuring, since 2020 is not a really good comparison, to use because of the lockdown, it would give you all sorts of distorted information. We went to 2019 to see, well, how do we compare to a more normalized 2019? Because up to this point in 2019, that was a pretty good year until we had cold weather in the north, and then June kind of went south on us. But this is measuring from January 1st of this year to a couple weeks ago. And it's week by week, the change really at retail compared to 2019. And basically, the long story short, for the first 21 weeks of this year, retail's up probably 20% higher than it has ever been. That is it's a strong number. But it's decelerating right now. It will begin to decelerate. And the reason it's decelerating is not because there isn't demand out there. Demand for boats remains strong, interest remains strong, participation remains strong. Inventory isn't around. You just can't sell what you don't have. And we have almost no inventory left in the field. And you look at the right side of the page, these are the manufacturer shipments. We were doing pretty good for the first month and a half until the storms hit Texas. When the storms hit Texas, they took down some chemical plants that were used for resin. That impacted production beginning in mid-March, and to this day, the supply chain has done nothing but get worse. And so this is really limiting production. We're producing less boats today than we did in 2019 when you adjust them for the price increases that they had for those 2 model years. So it's really struggling to get along. Now, the impact of that on inventories is for the trailing 12 months ending May, shipments are up 12%. And you would think that's really a good number, but that also includes a prior year that had 9 weeks of a shutdown, of a plant shutdown. So it's really, it's not very strong, quite frankly. But retail's up 32%, those trailing 12 months. When you add that together, kind of weak or tepid shipments, really strong retail, you just blew out $3 billion worth of field inventory in the industry. And that's half the industry's gone. And the rest of that inventory that's on the ground, probably 70% of it is already under contract. So it's just waiting for a closing. The chart on the left just gives you a measurement of weeks on hand in the inventory in the field. So weeks on hand is just another name for days sales outstanding or inventory turns. It just shows you, how many weeks of supply that you have of inventory available. And since we're a seasonal business, we stock up in the winter and we sell through in the summer during the selling season. That's why it goes up and down. But you can see on the right side of the page, it's the forecast through the end of the year. We've got inventory depletion out there as measured by weeks on hand. And the orange bars just show you whether you're adding inventory or taking away. And you can just see the run on inventory that happened beginning in May of last year. The table on the right gives you the absolute value of the weeks on hand. And we were actually normalized on weeks on hand when this pandemic started in March of 2020. We were in a good place for inventory. We were right where we should have been. Then the run on inventory happened. And today, at the end of this month, we'll be at 6.5 weeks, where we should be about 21 or 22. July is going to be worse. We're going to get down in the 5s. We're going to end up with about 37 days worth of inventory in July before we start the climb back upwards. But at the end of this year, we're actually going to have a little less inventory than we had a year ago December 2020. And that was, half of what we should have. So this $3 billion hole in field inventory, it's about, if retail stopped today, manufacturers could produce for 100 days and they would refill the channel. But they just can't do that. They have to actually build to retail, and retail's 20% higher than it's ever been. So they're having trouble ramping up to that with the supply chain and labor issues that they've got going on. But in addition to that, they got a 100-day hole they have to fill. That's just going to take a long time to do it. And so what that's going to mean is that the rebalancing or normalization of field inventories isn't probably going to happen until late in 2023. We got another 2 years or so of working through inventory depletion because it's just so depleted, things are gummed up, and retail remains strong to this day. You'll hear some public companies in the industry make comments on their investor calls about this. And if you listen to those investor calls the last several quarters, the next call pushes out the correction. So one thing that we've all done as industry participants is we've underestimated the retail demand. Who would have thought that we would have this type of retail demand? And we've also overestimated how much shipments are going to come into the channel. So meaning we underestimated the supply chain issues that are impacting our industry. One of the things that Wells Fargo does is we developed a forecast model. So the industry really doesn't have a forecast model for new boats. We do it for 5 segments, and the 5 segments we chose because they have a lot of data in it, and you can't really build a model unless you have a lot of data in it. Unfortunately, the yacht industry does about 1,000 units, new boats a year. That's not enough data to build a reliable model. But this will give you a proxy for the overall industry. But one thing with models is they used to work and now they don't. Our model takes retail registrations for the last 10 years, and it takes about 8 economic variables, and it creates an algorithm to forecast what's going to happen for the next 6 quarters. And it's been pretty reliable up until last year. And last year, what doesn't work anymore is that when GDP goes down, boat sales go up. It usually doesn't work that way. And what won't work in the future for a few periods here is that it doesn't measure inventory depletion, because we have now a physical ceiling on how much we can retail in any given month based on the available supply of inventory that's on the ground and coming to your dealerships. And so we've kind of figured out a mathematical equation in our book of business that the most that the industry is really apparently capable of retailing in a given month is about 50% of the available supply. It just takes time to bring it in, close it, prep it, deliver it. And with that, so we've kind of turned off our forecast for 21 and 22, but we have used our own forecasting for our own business and using that math equation to try to figure out where we think things are going to be. And what we're going to have in 2021 is, like last year, a tale of 2 halves. We're going to have a really strong first half this year at retail and a weaker second half, not because we don't have demand, but we don't have supply. And so we're seeing, double-digit retail growth rates for the first half of 2021, but we're seeing, low double-digit decline in retail sales for the second half, all based on availability. And for 2022, we're going to have kind of the reverse of that because we're going to have difficult comps, with the first half of this year. So, and we're going to come into the year with really limited supply. So we're going to see some negative numbers for the first half of 2022, and it'll reverse the second half of 2022. One of the other elements of our really strong calendar year last year, 2020, with a 15% unit growth rate, is we had a lot of new buyers come into this market. And what that did is it really drove almost the entirety of our growth in the industry at retail for last year. And the good news is, over time, half those people stick to the industry, and we've already heard anecdotally about some of those folks who were new to the market, who came in and bought a boat, are already trading up. So that's encouraging. We are going to lose half of them, which means there's going to be a lot of late model pre-owned boats that are going to come in the market in the next 4 or 5 years. But our dealers tell us bring it on, because we've never had enough late model pre-owned inventory to satisfy demand. So this government action actually worked out for us. It's going to add another retail layer to our cake. It's never happened in my lifetime. Usually we're on the other end of that trade. So we've, for the foreseeable future, we're going to have, call it a 10% bigger market than we had pre-pandemic. Looking at the inventory days, everybody says this is a two-turn industry. So 180 days of supply in new boats in the market, and that's been true. It wasn't true in the last financial crisis, when the music stopped and like normal, people stopped buying boats, plants shut down, inventories just sat there, so the turn slowed down. But this time, we had the run on boats, and you can see on the right side of this chart, for 2021, the average days in inventory is going to be 72 days, a little over 2 months. A 6-time turn for this industry is unheard of. It's normally a 2-turn industry. And with supply depletion being carried over into 2022, we're going to see an abnormally high inventory turn next year as well. So very good for dealers because they've got record sales, they've got margins higher than ever, they've got very low carrying costs, and they probably got a little PPP money in the bank that's going to be forgiven by the government. So truly great times for our dealers right now. These next 2 slides are a bit of an eye chart, but they tell the same story. This is from our friends at InfoLink, who give us retail registration data. It's really just days in inventory for the saltwater fish boat group, and of various size ranges. You got small boats, 16 to 22, you got 23 to 29s, you got 30-foot plus salt fish boats. They all tell the same story, is basically the days in inventory is going down. It's just measured differently. And the only thing to note is that it typically takes about 60 days longer to retail a 30-foot boat than it does boats smaller than that. And it has nothing to do with the demand side. It's about production, because the measurement on this chart is from the hull number stamp date to the registration date. Longer production times means, higher numbers, but it's all relative. It's the same run. And then we've got the yacht market here. This has a little different flavor to it. So the yacht market, we've got 30-foot plus boats, 30 to 50 foot in the blue line, and then we've got 50 to 80-foot boats in the orange line. The anomaly with the bigger boats is a lot of those are coming from overseas. So in addition to supply chain issues, now you've got transportation and lockdown issues that are a little different overseas than what we have here, that really from the hull number stamp date to the date that it's registered with the Coast Guard just adds a little time to it. That will come back down to normal. We had actually seen that the 50 to 80 foot had been really strong for quite a while. It's just an anomaly with most of those manufacturers being international builders at this point. The last thing I'll touch on, as I mentioned at the beginning, this awful idea of a luxury tax coming north of the border in Canada. So the provincial governments put a budget in place that's being voted on this month that has a luxury tax on boats and planes. It's expected to take hold January 1, 2022. but it requires 2 rounds of approval. The first thing is this month, they're going to vote on the budget. It's expected to pass. The second thing is in the fall, certain elements of that budget have to be voted on and approved for being included in that budget, of which this bill is one of them. So there's advocacy efforts underway led by the NMMA to try to get information in their hands to say this is a regressive tax, this is a bad idea. If they're unsuccessful, it starts January 1. It has already started changing consumer behavior up there and dealer behavior. And what it is for boats is it impacts boats over $250,000 Canadian, which in US dollars is about $189,000 in today's exchange rate. That's not a big boat. It's like a 30-foot boat. And the calculation is you're going to pay the lesser of 20% of the amount over $250 or 10% of the retail sales price of the boat. And where those two things diverge is about $500,000 Canadian or $375,000 US. What a lot of people don't know, and consumers and dealers up north don't know, is this applies only to new boats. It doesn't apply to used boats. That's not very well known at this point. And if you recall with the luxury tax that hit us in the early 90s, it wasn't well known that it didn't impact every boat. So there's scope creep in the minds of the consumer that's potentially going to happen up here where all boats are bad, all planes are bad. And it's already changing behavior up there, so those consumers that do know, they want to buy a boat right now. They want it in this calendar year to avoid the tax. Some of them are trying to figure out creatively ways of changing jurisdiction. Some of them are saying, well, I'll just buy a used boat, but you know, the supply of late model used boats isn't real good either. But it's going to place a premium on pre-owned values if this thing goes through. That's what's going on with the Canadian luxury tax. You know, it's a bad idea. Hopefully NMMA is successful to the extent your association can get involved with NMMA to stifle this, because we don't want anything of this to creep south of the border, you know, into the hearts and minds of tax and spend government officials who have wealthy people in their crosshairs. So that's our presentation today. Honestly, these are the best of the times for the boat industry. They're not without their challenges. We've got a multi-year period where it's going to take us to rebuild the inventories. One thing I didn't mention is on the new boat side of things, get ready for the largest price increase you've ever seen in your lifetime in 3 weeks. On average, it's going to be between 8 and 12% for new boats. Without any guarantee, there won't be a mid-year price increase. The inflation issue is real. The production issues are real. The labor issues are real. And it's not all transitory. So any questions?
I've got a question right here from Tom.
Yeah, Edward, thank you. I just was curious on the negative side of obstacles that we see going forward. What Wells Fargo or the analysts have looked into is another challenge that I didn't hear a lot about, which was storage. We're seeing ELS, we see Safe Harbors buying up a lot of marinas. I know I'm in one of the biggest marinas on the west coast of Florida. It's totally full. You're a year out to put a boat. What is the risk, or down the road, a year from now or 2 years from now, where are we going to put all these boats? Because it's seldom you see them building too many more marinas, other than you look at what they do in Europe when they don't have a lot of space. They put them all in the water and they put them on a mooring ball and pull them out. But I just don't see the infrastructure being built. It's like selling too many cars for highways.
Yeah.
And do you have the infrastructure to store and house these boats? Is there anyone been looking at that and then wondering what the big plan is down the road? Now that's more of an NMMA issue, probably to look into where it's going to go to.
Right? Yeah.
But we see that, I see that as a big issue, because I just don't know where we're going to put them. Other than a trailer or a house on the water is the only thing, you know, control-wise.
Access has been an NMA issue for a couple decades. So it's not a new thing, but when you pour 30,000 more boats, into the channel in 12 months or 9 months than you had before, you're going to feel it a little more. So I don't have an answer for you, but clearly it's access and storage are key impediments to customer experience, and customer experience is key to retaining boaters. So somehow the industry is going to have to solve it, and capital is going to have to be deployed, and that's going to take a lot of work to get done.
I think Chuck Cashman's going to announce 50 new marinas on the coast of Florida here.
I wish. Hey, Ed, thank you so much for all this. When you talk about rebalancing the inventory in mid-2023, are you baking in a slowdown in consumer demand or a ramp up in manufacturing, or a little bit of both?
It's kind of a flattening of retail and a slow ramp up of manufacturing. And it's really, to get closer, it's probably the fourth quarter of 2023.
It's scary when you look out, right? If the trends stay where they are, I wonder if the manufacturers can ramp up that quickly. But I know you look at a lot more data than we do, so it's encouraging.
We update our forecast on that, Chuck, really weekly. But we have yet to pull back on when the correction's going to be. We've only pushed it out.
Yeah. Okay. Thank you very much for all this.
Incredible. Gary Smith has a question. I'm coming. Focus cameras over here, please.
No cameras, please. Ed, thanks. Exactly. Thanks for a great presentation, by the way. My big takeaway and surprise was associated with a little background. The 9 million unfilled jobs, I think I heard on the news a couple days ago.
Yep.
There's rampant inflation in housing and building materials and home sales, existing home sales, and boat sales. You just mentioned 12% increase up to potentially across the board. My big shock and surprise is that you forecasted no Fed increase. And I wonder how much faith you have in that forecast. And secondly, if they did an increase, how would that change your forecast across the board, or would it change your forecast across the board? I mean, the other thing I was going to mention is the amount of money and liquidity being poured into the economy and devaluation of our money. Mm-hmm. But to me, I thought the Fed looked like they were asleep at the wheel. But from what you were saying, they were basing it on jobs, but there's plenty of jobs out there. So can you elaborate on that?
Well, people aren't taking them. So it's the unemployed right now that they're looking at, and the slack in the labor force, the 9 million, jobs you spoke about. I think May had last 2 months had really underwhelming unemployment numbers for new job creation, way less than any of the consensus forecasts. So people are still not going back to work. Ask any boat builder, go to any restaurant. You can feel it here in the hotel, that people are still sitting home. But I was visiting a manufacturer last week in Indiana. Their state got rid of the extra incentive to stay home, and their HR department immediately started getting phone calls. So people are, these programs are going to end in the fall. And so when they end, the labor force will come back the second half of this year. They'll start to work, but it's going to take a little time for them to have an impact. The unemployment forecast for Wells Fargo was, I think, 4.6% for 2022. Still much higher than where we were pre-pandemic. So it's going to take a while for it to come back. But Wells Fargo's position on interest rates is the Fed is concerned right now only on jobs. They view inflation at this point as transitory. I think it's a mistake, but they don't. You don't raise wages to try to recruit people and then 9 months later say, okay, you got a 30% pay cut. I mean, wage inflation is real and it sticks. Building a boat in a COVID world that's less efficient sticks until you don't have to do that anymore. It's just going to cost more. Some of these things are going to stick. But lumber prices going up 2x, that's probably going to come back down.
I think it was 27 states have discontinued the federal
Yeah.
portion of the subsidy.
Yep.
Any other questions?
Yeah, thanks for your presentation. Is it my understanding when you're talking about Wells Fargo's position on the boats is more on a boat inventory basis?
Yes. Yeah.
Does Wells Fargo finance individual yachts above 70, 80 feet or?
For the consumer?
Yes.
No.
Okay,
we don't.
so it's
No.
not a program. So
No.
this is more for the
Inventory
floor
finance,
plan.
floor plan side
Yeah.
of things, yeah.
Thank you.
Ed, wonderful presentation, thank you. I remember a time when the Fed and the administration wanted interest rates to stay low, but the bond vigilantes showed up and raised interest rates. Could that happen again?
Who knows? Who knows? There's all sorts of dark clouds out there of things that could happen, but those are unintended consequences and impossible to predict. Recessions happen for bad policy or wild card events that happen, and you can figure out how to forecast bad policy, in your economic modeling. You can't forecast some external shock.
Any questions from this side? Answer to a question is we're turning the air conditioning up. So we will not be in subarctic mode here in a little while. Thank you, Laura Hogle. Any other questions for Ed?
Darren's got one over here.
Darren's, I'm sorry, guys. God, you Galati guys are so, inconspicuous.
Put it right here. Great presentation, by the way. Super job.
Thank you.
I'm just curious what your pulse is right now on the importation of European boats and how the effects of COVID right now are affecting year over year, at what percentage levels. I know we're feeling it at the builder level coming in, but just what kind of impact are you seeing?
Well, we've been talking to builders overseas. They had a longer shutdown than what we did in U.S. plants. Our plants typically went offline. Only 70% of them went offline. Those that didn't go offline went down to about 50% production. But the 70% that went offline from mid-March to around May 1st. So 6 weeks on average. But then there was a slow ramp up, to get back up and running. It took them about 60 days. The European builders went down at the same time, but they were down for the entire month of May as well. So they were down another 30 days, and then they had a slow ramp up, and they really didn't get back up and running until late in the fourth quarter of 2020. And some countries, if you're in France, for example, they shut you down again. So you had another shutdown that was happening. So COVID has not treated the world equally, and you can see that in the United States as well. It's really hitting production differently across the globe. It would probably hit Asian production pretty bad right about now. Yeah.
Yeah, Malaysia's been completely shut down, and Grand Banks is closed until the end of June.
Yeah.
And they've got an incredibly full order book as well. Any other questions for Ed? Ed, thank you so much. That was an
Thank you.
incredibly informative presentation.
Thank you.
Bob Saxon.
Wow. Okay. Great presentation, as everybody's already remarked. Those veterans in here remember the debacle of the luxury tax that was put on the yachting industry many, many years ago. What a disaster that was, and the government cost the government more money to run that office to collect taxes than they actually collected, because everybody just ran offshore. So we'll see how that all pans out. I'm going to send you on break now. I know a lot of you are really churning to get out there. There's some goodies. There's some novelties out here. Don't forget these pink sheets. And we'll see you back here in about 20 minutes or so. Listen for the gong and take a break.